folks, and welcome to the Rate Update with Dan Frio. My name is Dan Frio, and I give you the economic news of the day that's affecting and shaping real estate. So here's where mortgage rates are today. We're going to get to those in a second. But let's get over to the stock market to see, what's going on in the stock market right now. Well, just 5 minutes ago when I logged in, the markets were completely flat. So you're going to think, okay, what's going on here? Well, I thought it was going to be flat today as well because everybody's sitting on the sidelines because of this. Stocks fall Tuesday as with investors on edge before the federal rates decision. If you looked at the NASDAQ yesterday, I haven't seen this in a long time. I think the NASDAQ was down 1 point. Very rarely do you see the NASDAQ just in single digit numbers. But let's get to the economic calendar. What's going on for today? So to do that, let's get over to our economic calendar. This is the only thing we got coming in today. Building permits. Well, they came in actually a little bit higher than expected. What happened last time is 1.44 million permits were issued. This time the analysts were thinking it was going to be about 1.44 as well. It came in at 1.54. That's good news, but we might even have a little bit better news if we dissect the numbers. So let's get over to, because there's no really economic news out the rest of today, let's break down the housing numbers. Now, here's where we are right now. And why I want to discuss this is most of the construction that's been taking place they've been ramping up on 2 to 4 unit buildings. So here's a chart what's been happening over the last, since January of 2000. You can see up on the top, red is indicated by single family units or 1 unit buildings, and the blue line indicates 2 to 4 unit buildings. You see that they were on the same trajectory kind of going over time since basically the crash in 2000. But look at right at the end of that, the charts. Look at blue, how blue is completely tumbling all the way down, and red's still there. It's up. It dropped a little bit, but it's on an upward trajectory. Here's why I'm saying is good news. Builders have been building a lot of investment properties because a lot of people have been investing in real estate. They can lock in yields or rates at 2-3%, back in the heyday, and they're getting great returns on equity or on investments on this. But then they realize, well, there's still a pent-up demand for people looking to still buy single-family homes. Yes, even with rates in the 7%. Okay, so now they're saying, okay, we might have an abundance of rentals. Now let's start ramping up our single-family homes. So this is basically the only data that we have out today. So what I thought I would do is start looking into the jobs numbers, especially what you see in the headlines right now. We have the United Auto Workers on strike, the Writers Guild, and a bunch of other entities and unions on strike. So let me just dissect that a little bit for you. The Actors Guild, UPS, and now the United Auto Workers are on strike. Well, the strike, I think in many cases, in their case, is once you really dig into the details, I think it's pretty much needed. Most of these workers got about a 6% raise in the last 3 to 4 years, or basically since the pandemic. Inflation last year was at 9%. So your wages aren't even keeping up with inflation. What I want to show you guys is right at the end of this article. It basically comes in and captions this. There are some signs that the American workers will become less restrictive. The U.S. labor market is starting to return to pandemic levels. That's a good thing, and I'm going to show you some of these levels here shortly. With only 150,000 jobs added to the U.S. economy over the past 3 months. 150,000 jobs in 3 months. That's about half the rate seen during the first quarter of 2023. Quit rates are starting to slow down, indicating that there are fewer opportunities luring workers away from their current jobs. With less leverage, unions and workers may opt for less aggressive tactics. So let's kind of analyze what's happened over the last, say, couple years. This is where we were during the pandemic when everybody basically stopped working. Okay, there was about 5 people looking for every job opening. So that means, as an employer, you can sit back and say, okay, I got a lot of, people applying for my jobs, and I can be picky. Well, then the tables turned. And then you got down through here, there was basically a half a person for every job opening. So as an employer, you're like, I got to entice people. I got to entice workers. Like I go to Florida a lot. During the pandemic, I was talking to a lot of the business owners, restaurant owners, and they're like, the tactics they were using to just keep servers was amazing. They were starting to give pension plans, benefits, perks, raises, and all kind of other things. But the problem now is there's not as many job openings. So the people can't be, as an employee, you can't be, moving jobs all the time for better wages or higher wages because they're just not out there. Okay, so what we don't want to look at too is right here. Here's the data of how many jobs have been created. Look at where we are in 2023, especially the last 3 months. It's fallen off the charts. So this should be, basically add to the cheering of what the Federal Reserve's looking at. They're saying, okay, we want jobs to be crushed. They're getting it. We want wages to be crushed. They're getting it. We want the housing market, the real estate market to get crushed. They're getting it in the terms of units sold, not on prices, on units sold. So that's the data we have for today, folks. There's not a lot here to digest, but I want to give you the facts behind things. We're starting to see inflation coming down and coming down rampant. We see the shelter numbers. If you haven't checked out yesterday's video, check out my video in regards to shelter numbers, as well as student loan debt, going to add to this debacle that we have right now, taking a lot of money out of the systems. So with all this, it should be nothing but good news for the Fed. So the Fed should take their foot off the gas pedal of increasing rates and just let time take its toll. Because in yesterday's video, I also broke down how student loan debt is taking about $28 billion of money out of the system each month because of people they didn't have to make student loan payments in the last 3 years. Now, once it's started back up, do you realize the average student loan debt is $500 a month and there's $43 million with student loan debt? That means that there's, 20, I think I did the calculations yesterday, $21 billion each month going to go to student loan payments that were being used previously in shelter, recreation, food, and a lot of other things that we do on a monthly basis. So that's my report for today right now. So based on the data that we have, is there any expectations that the Federal Reserve will not raise rates at the next meeting? Well, here's what we go to. We go to the CME FedWatch tool. This gives us the likelihood the Federal Reserve will change the rates at the next meeting, and the likelihood that they're going to do that is 99% chance that they are not, because right now the federal funds rate is 5.25 to 5.5. There's a 99% probability that they will not increase rates tomorrow. So with this data, what's happening to the bond markets? So I'm a mortgage advisor. If you're out there and looking to kick the tires to maybe get pre-qualified for a home, maybe you want to buy your first investment property, at least look at your options. All I ask you to do is don't disqualify yourself. Please make sure you reach out to us. But I watch on a daily basis, I watch the bond markets, okay? There's a 10-year treasury over there. I really don't have it up here. I just have it up here to monitor kind of what's going on. But what we focus in on right now is the MBSs. This is a mortgage-backed security. It's a mortgage bond trading on Wall Street. That's yield is the biggest piece of your mortgage rate. All you need to know is you're seeing this number move. This number is going down right now. So if the price of the bond, which you're seeing right here, the price of the bond, if that price is going down, rates are going up. There's a yin-yang effect, and most often, every couple of weeks, I'll explain how this works. So check out some of those videos or just subscribe to my channel on a daily basis so you can learn how this works. So let's get back over to where mortgage rates are. Okay, these are where mortgage rates ended yesterday. These are the top 6 programs people use when they're buying or refinancing a property. What happens here is Mortgage News Daily. They're the company that published this. They send surveys out to lenders all over the country, and they ask them these 5 questions. If you had a first-time home buyer buying their primary home, and it was a single family home, it has to be those criteria. 740 credit score, putting 20% down, those would be their rates. Well, you might be saying, Dan, I'm not putting down 20% because I don't have to. I only need 3% down, right? Yes, you do in most cases. Well, your rate might be a little bit higher than this, but if your credit score is higher than the 740, you might have the same rates. So if you want to, you can check with us to see, if you're locked in another lender right now, we can analyze that rate for you. We can review the loan amount, the interest rate, and the fees they're charging you. How do you do that? How do you let us analyze it to give you basically a second opinion? Well, go to therateupdate.com. Here's our website. And you can go right here, loan estimate. You can upload your loan estimate in there. Give us a couple hours to review it, and we'll get back with you. We're going to either get back with you with one of 2 things. We're going to say, hey, kudos to you. You did a fantastic job. You locked in with the right company at the right time. What happens most of the time is this. We can get you a lower rate and lower fees. And I said, and lower fees. So please check it out. You might be surprised on what you can get. But if you're out there and you're like, hey, Dan, can I talk to somebody, or how do I just start this whole process? I'd like to kick the tires to see if I could qualify to buy my first house. Well, 3 ways. 1, you can hit the Apply Now button. It doesn't really go to the Apply Now tab or link. It's actually going to ask you a few questions to kind of give us some information about you. And then it's going to sync you with the appropriate person or staff member on my team to talk to you, so to make sure they understand what you're looking to do and we understand your situation. Or you might say, Dan, how can I just call you guys or email somebody? Well, go to the bottom of the website and here it is. You can call us at 844-775-5626, or you can email me directly, and yes, I will be the one replying. You can email me at dan@therateupdate.com. Thanks so much for watching, guys. Can't wait to see you tomorrow when the Fed announces what they're going to do. I might even have a live event at that time to kind of break it down so you guys understand what the Federal Reserve's doing and what their projection is in the future. Are there any future rate hikes coming, or should they take their foot off the gas? So I'll see you tomorrow, folks. But if you haven't yet, please subscribe to my channel down below. Love to have you as a member. Take care. Have a great day. Bye-bye.